to myself, I guess, after a short break with Lou and Doc taking over and handling the reins. But good morning, Doc.
Yeah, good day, Graeme. Great to have you back. Not that it wasn't a lot of fun with Lou, but you are the man, I think, and you're back in town.
A bit more tanned of a man because I was over in the States and Mexico and all sorts of places doing conferences. So I got a bit of a tan while I was learning. It was great.
Well, that's great, and probably a good thing because we're coming up to winter, aren't we? And
Absolutely.
The sun will still be there, particularly where you are up north, and but it won't be as hot as it is during summer. So maybe not so much of a suntan. But look, it's May, Graeme. You know, we're really rolling along the year now. We could almost say we're getting towards halfway through the year. Which is
pretty much. The only thing is, Doc, it's Mayday, Mayday, Mayday. Help! Because
I don't think there's a lot less Maydays going on now, particularly in regard to our housing market. We discussed last week the backflips, and we'll have a look at another flat backflip that's happened over the past 7 days in terms of those predictions. But you and I have been railing against those clickbait forecasts for house price crashes. Just didn't occur. It's sort of deja vu all over again, compared to COVID. We had the same sort of crazy forecasts of house price crashes. Didn't happen. In fact, we got a boom, and now we're seeing the banks, the Reserve Bank are all saying, okay, we got it wrong. It's not going to be a deep correction phase. Prices aren't going to fall as we predicted. But we've been saying this was inevitable really for months now, that Australia's housing markets are consistently robust and resilient, and we've got borders open, low building numbers, and interest rates are just being shrugged off by consumers. So I think the remainder of the autumn selling season will be very, very positive, Graeme, in most markets. With some now significantly in catch-up mode. I'm referring to the Melbourne market. Now that COVID's behind us, touch wood.
Yeah, the rates really aren't having the effect that they should be, Doc. The textbooks are broken.
Yeah, well, I'm not so sure higher interest rates have ever had that impact on house prices anyway. In fact, higher interest rates and the sort of the negativity that comes with them in terms of, conversations, all they tend to do is to sit buyers and sellers back on the sidelines, and what happens, of course, is once we start getting some clear air, which we've got now, despite higher interest rates, all that pent-up demand that's created through the sort of the negativity, it gets released. So typically house prices ease during higher interest rates, and then they take off when either we get a cut in interest rates or, we control whatever we're trying to control. And I think that's some degree what we're seeing now in the marketplace, Graeme, and I think that will pick up even more over coming months. It's those buyers and sellers that sat on their hands, through the middle of last year and maybe a little bit through spring as well, and now getting up and rolling because prices are good value. They're still below where they were generally a year ago. And, buyers are starting to think, well, if I don't get in now, I'm going to be paying more. And I can still purchase a property that's, less expensive or cheaper than what it was a year ago. And this is exactly what happened in 2019, Graeme.
Yeah.
So, interest rates, ho-hum.
Yeah, true. It doesn't really mean too much at all. So, Doc, we've seen that. I mean, it was probably 18, 12 months ago, you and I kept saying this fear factor, this drum they're banging of woe is me and the sky's falling and the market's crashing. We kept saying, we don't think it'll be as steep. It won't be as deep. And here we are now. Their values are lifting again. Everyone's going, oh, it wasn't as deep and steep as we thought. And in a lot of cases, half of the suburbs in cities grew when some of them declined.
Yeah. And, I think the important thing here is, look, okay, we can sort of be smarty pants here and say, oh, well, we were right, you were wrong. And that's fine.
We should.
Well, we could. And maybe we're doing a bit of that. And, okay, whatever. You need to do a bit of a victory lap, don't you? But I do think the important thing here is, and I think a lot of our audience through a number of media, are in the position of thinking about buying and selling. And I think it's if you listen to some of these clickbaiters and make a decision in regard to property, that's where the jeopardy lies. that's where you get your fingers burnt. If you can treat it as a bit of a joke, yeah, ho hum, ha ha, and focus on commentary that's credible and advice that's credible. I think that's what you've got to really take as being the lesson here is don't make a decision based on doomsayer scenarios. Look at data, look at historical experience, and look at what's happening with the key drivers. And that's what we, of course, try to do here is offer that service to our audience so they can make rational decisions.
Yeah, I think rational, and as you said, I'll take a scientific approach. The data is there; it's readily available.
Yes,
and to use the data and look historically what's happened. So let's rip in and have a look at that, Doc.
Yes, let's have a look at it, Graeme. And this is this week's production for our weekly look at the market. Of course, we had the Reserve Bank make a decision yesterday, this week. Early days was only the 2nd of May for their decision because, of course, their decisions are the first Tuesday every month. We had a real shock decision, and we discussed this, in my opinion, a shock decision last month. Not sure what the Reserve Bank's doing, but certainly I don't think it adds to what's been a lot of questions about their credibility and their performance. But no surprise, and we've predicted this, of course, and I think most did, that we get a rate increase following the pause last month. We got a 0.25% increase. I think it was a lost opportunity to some degree, Graeme, not raising rates in April. There was absolutely no justification from the data to have a pause. The Reserve Bank went ahead and did it anyway without any substantiation. The data that came through in April was, again, particularly strong. Labour market, retail sales and house prices rising again. Absolutely no sign of impact from higher rates on consumers. So the Reserve Bank really, and I think, Reserve Bank, given the government's proposals to change the Reserve Bank, I think we've now got a Reserve Bank that's, a little bit, what shall we say? I won't say shamed, but certainly under some pressure in terms of what's going forward.
Well, I don't think they can do right. They can only do wrong from here because they've already done. So they've done so wrong, but they're just. It's just, I don't think words can even explain it.
Well, any momentum that perhaps had been driven by those 10 consecutive increases in interest rates, Graeme, maybe we could say that was lost with the pause over April. So I
thought they would have just added a half to scare the hell out of everyone and then pause and reflect and monitor.
Well, that's right. I mean, you can imagine the headlines. And but I do think that, the problem now may be that, we'll look back and say, well, because it's goes for longer, perhaps the cycle, it's because you paused in April. You lost the momentum.
Do you think that losing that momentum, Doc, do you think it gives a bit of false confidence to the markets too to go, oh, everything's okay, they've stopped now? And that's brought some pent-up demand, and the people that were fear of being involved have gone, oh, maybe we're good now, and I think that's going to drive prices higher.
That's right. And that's the point. It wasn't the end of or even the point where there was any sign that higher rates had done what they were supposed to do, and that was to quell demand. And even the signs that were there, and yes, we've had a reduction in inflation. We'll look at that today as well, Graeme. But that's sort of would have happened regardless of interest rates. You would have still had, I believe, this reduction in inflation without interest rate increases. Because it was all about supply adjusting to demand following the COVID surge, right? Now, these things take time. It's finally sort of happened. I mean, you're not waiting a year or more for a couch anymore. You can get a new car a little bit quicker. All those sort of things, supply has caught up with demand. That would have happened regardless of interest rate changes. But the problem is now those interest rate changes and inflation is working its way from goods, which have started to adjust positively, into services because, higher wages means the boss and employers are having to put up their prices to cover those higher wages, which are coming from this very tight labour market that we had. And that's going to be the issue going forward, is not so much the price adjustments from supply. It's going to be what's happening with prices in relation to prices versus wages versus prices. As everybody's trying to catch up, bosses are trying to catch up with higher wages by putting up prices, and employees, workers are trying to catch up with higher prices by putting up wages, and on we go. And we have this very tight labour market and no signs of that slowing down. So I could say the rate outlook clears because we paused after 10 in a row. We're thinking, well, what's going on here? Where do we go? But it's now clear that we need to have more interest rate increases, and we've had the first of those now for May, and I think we've got a few more to go as well, Graeme. So no surprise, the RBA has resumed rate rises after that April decision to pause following 10 months of increases. Inflation's still, significantly higher than the target range. We'll look at that shortly. And the economy continues to boom, low jobless, strong and rising retail sales, and house prices, they're on the rise again, not just in Sydney. Our data, our April housing market report, Graeme, which we're going to look at today quickly, has shown every capital city with an increase in house prices over April. So it's not just one or two, it's every market now with upward energy in house prices. So there's
it can't be true. It cannot be true.
It is, and you heard it first here. So there's our cycle. And we can see now that, look, okay, we've had another rise. We've had all those rises since May last year. But we're still nearly 1% below where we were at the peak in 2011, Graeme, of our last tightening cycle. So, in real terms, the interest rate is still, very low compared to the historical trend. And as I said, we're still below where we were back in 2011, and I think maybe we've got to get back to there at least for this for inflation to start to significantly ease, underlying inflation. So yeah, another rate rise. Just on rates, Graeme, I think the US are going to raise their rates tomorrow. I think we'll get that announcement. I think there's still a lot of work to be done in the US. They have bigger problems than we do in terms of wage price spirals because, as we've explained, the US have a different wage setting system. They're almost a pure market force. You can walk into the boss and say, I want more money. And if the boss is under pressure to find workers, they're going to have to pay you. The reverse is that if there's lots of workers around, the boss can cut your wages just like that. So there's no real protection up or down for either employers or employees, whereas here we typically have annual wage reviews, maybe sometimes 2-year wage reviews. That means you've got to wait a year before you can get your wage rise. So that acts as a bit more of a stumbling block to the type of wages, prices, outcomes or, spirals that seem to be occurring in the US, which is a good thing for us. But it doesn't mean at the end of the day that we won't see higher wages eventually. It just means that we have a bit of time to adjust to that occurring, which is why interest rates should be working a bit better than they are at the moment. But 3.85%, Graeme. Again, as I said, not too, still, pretty well below where it was in the previous tightening cycle. And I think we've got a few more to come, mate, and we'll look at those drivers and just exactly why I do say that. So I do think that pause also helped to keep housing markets that were already reviving. You said that before, Graeme. It was a signal, hey, we don't have to worry about interest rates anymore. Let's get in and, buy or sell, which we had been putting off. I think that May increase indicates more to come as inflation resumes. Now, I was just going to say, Graeme, that I just want to point out that this was from the statement that the governor made, and I said I don't want to pick on him too much, but this was the statement yesterday that he made in regard to having to raise interest rates, and he said that the combination of higher interest rates, cost of living pressures, and earlier decline in house prices is leading to a substantial slowing in household spending. Where's this substantial slowing in household spending? We're going to get the retail sales for for March out today, Graeme. So that'll be interesting to see how retail sales are going.
I'm sure Mr. Lowe's qualified appropriately because it's almost like he's got that statement back to front. I haven't
I know.
seen a slowing. I've seen increased spending in households. That's what's happening with some of the. Anyway.
Yeah, but this is the point. I mean, what's the substantial slowing that he's referring to? Cost of living pressures, earlier decline in house prices. And that's the new word they've put in there is earlier. Because until now they've been saying a decline in house prices because it was, they were saying it was continuing. And now of course, we know they've backtracked on their forecasts. We looked at that last week for house prices. But, they're saying this, that household spending is slowing, and yet house prices are rising across the board in all capitals, and retail spending is rising and still at very strong levels, So I can't quite work that out. Maybe they're referring to another month. They've I don't know, cut and paste or something. But certainly it doesn't. The data is not substantiating that position that there's a substantial slowing in household spending. So, and the real data is what we have to rely on, and that's the ABS data and the trends that is consistently revealing. So we know that it's all about inflation, Graeme. We've had the latest inflation data out, and by saying the latest data, it is the March quarter data. So we are looking back to January inclusive of this data. So that's a little bit, okay, whatever. However, that's the official data that we have to run on. The Reserve Bank said that new monthly data set is sort of interesting, but, don't hang your hat on it because it is still a little experimental. So this is the main data set that they are after. We can see that there was a drop in underlying inflation. Underlying inflation, which is the preferred measure for the Reserve Bank, Graeme, which takes out the volatile items such as food, which can jump around according to seasonal factors, but it fell from 6.9 to 6.6%. So that's a decline, which we welcome, but without trying to be, be the doomsayer here. We've still let's understand that the target is 2 to 3%, Graeme. 2 to 3%, and we're at 6.6. And even the Reserve Bank in its statement, it's in its statement that it made yesterday or on May the 2nd, said that it doesn't think we're going to get back to 3% until 2005, 2006. So, there's a long, long way to go to get back, according to the Reserve Bank at the moment, to get back to that underlying inflation target, which is 2 to 3%. And let's remember that a lot of the smarties and the commentators were starting to say that before COVID, because we were in the reverse mode where lower rates weren't creating inflation, that they were talking about let's change the target, to 1 to 2%, something like that. Yeah. Imagine if we had a 1 to 2% target now, Graeme.
We'll never get back there.
How long would it take to get back there from 6.6? And this, of course, is the danger of changing the target. How often do you change it? When do you change it? What is it that makes you change it? So, and again, they were proposals that came out from the Labor government. The Labor government's the body that they've appointed to reform the Reserve Bank. They were suggesting maybe we have flexible targets, and that would be really a recipe for disaster, in my opinion. So 6.6%, good news. Headline inflation, which covers everything, Graeme, was down to 7% from 7.8. Underlying, as we mentioned, down to 6.6 from 6.9. March quarter was up 1.4%, which was lower than December, 1.9, and lower than March last year, where inflation rose by 2.1%. Travel and gas prices were the main contributors to higher inflation. Graeme, we're all travelling again, and that's putting upward pressure on prices generally. The price of gas is going through the roof. This is all part of that transition to a carbon-free economy. And also and that was a contributor to higher inflation, to the inflation number. But the relief we had was from new homes and fuel costs, which is petrol costs were lower. But new homes were lower, but they're still really high, mate. That's new home building costs, which we've alluded to. And the price of petrol has eased, and that's because the price of oil has fallen away. We'll have a quick look at that in a second. So these are adjustments, particularly fuel adjustments, are about the supply catching up with demand. But a few grey clouds on the horizon in regard to fuel, Graeme, because the fuel producers are now talking about reducing production, which could mean higher costs. So we need higher price of oil. So we need to keep our eye on that one because that would work its way into inflation. But as I discussed before, the bad news out of the inflation data with service prices continue to rise. Service prices are now at their highest since 2001, Graeme. That's a very sobering statistic. But goods price growth is easing as those supply lines now, those COVID-constrained supply lines now start to adjust positively. But we've got to keep our eye on services prices, and that's what's really driving inflation in the US and the UK. It's that services price environment that we discussed before, Graeme.
Mm.
So we do have our latest data on the housing market for April. So hot off the press, Graeme.
Surely rents have calmed down and values are still settled and everything's okay.
No, it's not, Graeme. Not if you're a tenant. Pretty good if you're a landlord. But the April data showed no relief. In fact, the one, I guess, bright spot for tenants a year ago was that we had plenty of rental supply in those Sydney and Melbourne inner city markets, Melbourne CBD and Sydney inner suburban rental markets for units. There was plenty of choices. Forget it now, mate. That's all gone. It's unit rents are caught up with houses. It's a perfect storm of higher demand, students, migrants, and less supply. We're not seeing new building coming through at anywhere near the levels we've had previously. And, of course, we're seeing, some landlords moving out of permanent and back into Airbnb when they shifted into permanent from Airbnb during COVID because there's plenty of demand for those short-term rental products. And, of course, we still have a chronic shortage of house vacancies driving that market, and that's all about, the shift to the home office and working remotely. So, again, no good news over April. And, in fact, April should be a better news month for tenants, Graeme, because it is a holiday month. Typically, we see distracted landlords and students, sort of think, I'll wait a while before I make that planned move because of, we have Easter holidays, Anzac Day, lots of long weekends, and that typically means higher vacancy rates because of the seasonal effect through April. Didn't have any effect really on rents. Look at the Sydney unit rents, Graeme. They've now caught up. They've been saying it's going to happen.
That is insane.
That's insane. $700 median rent for a unit in Sydney, which is the same as a house. And let me just give you a quick insight, Graeme. We don't want to get too early in this, but the latest data, and I'm talking the last week, is showing rents for units are now climbing above rents for houses. So there is this drive for rentals in Sydney. Again, those factors I mentioned, higher demand, students, and less supply, lack of new building, and the Airbnbs moving back into permanence are meaning it's becoming very difficult to rent a unit in Sydney. And it's no different in the other capitals with the gap between units and rents now falling. And I think we'll continue to see that. It's only a small margin now, except for Adelaide, which has a very small unit rental market. There's only a very small margin between rents and units. And that's because until recently, unit rents were more affordable. And there was more supply, but forget that now. It's now looking like that, that unit rents eventually, maybe even across the board, with the exception of a few of those smaller rental markets, may be more expensive to rent a unit than a house, Graeme, which is extraordinary. So this is the growth rates over the month. We saw, again, strong growth in Sydney and Melbourne in Sydney for unit rents up by 4.4% over the month. Big rise, and that's obviously given us that $700 a week. But rent's still rising over the month across the board, Graeme, and that's despite those, which we'll see in a minute, higher vacancy rates. Look at this. Look at these numbers, Graeme. This is the annual rise. Look at Sydney unit rents are now up 40% over the year.
Wow.
But they're not alone there. Big rises across the board for both houses.
Excluding Adelaide, Doc, being a smaller centre, everything's well over 20% there for units.
That's right. Yeah, that's and more to come because there's no relief. There will be no new supply coming in. There'll be more demand from migration. So this is presenting very big problems for tenants. I just want to mention quickly, Graeme, that the ABS, it measures rents as part of inflation because, of course, rents are a big cost to a large proportion of the population. Now, people say, well, gee, how come the ABS has rents only up 6% over the past year, and yet this rental data is significantly higher? Well, they actually came out with a paper to discuss this, and it was a motherhood statement, which was, yeah, well, we already know that. And that is that, of course, these are new rentals, Graeme. This is rents that are coming into the market. They're not obviously established rents, which the ABS measures through a survey and other data sources. But the point is, this is showing us what the market is thinking about rents now. And even though this doesn't get translated straight away into existing leases, it is the energy in the market, which even the ABS concedes, eventually gets passed on to all renters, So, and this is what we're going to see. And this isn't good news for inflation because these rises will eventually be passed on to everybody who has a lease. Well, just about everybody. Those that don't have perhaps or that have public housing leases are in a better position in terms of, government protection from perhaps these sort of rent rises. But make no mistake, this energy will flow its way through into all rental properties or most rental properties, which means, unfortunately, higher inflation as a result of higher rents that are in the gun. And this is what's showing us what's in the gun, Graeme, from the market as it exists now, which, of course, landlords are going to say, well, when the time comes to renew a lease, this is the data that I'm going to rely on. Estate agents are telling me this is what I can get, so this is what I want, even though they will obviously be wanting to protect to some degree longer-term tenants because there is a cost to turning over tenancies. But with these sort of numbers, we're obviously going to see higher inflation through or certainly higher rents contribute to inflation. And this is, as I said, this is in the gun, Graeme. This will come through over the next 12 months or more, and with no relief in sight, this is going to continue. And I think this is a big story, to be quite honest. And it means that rent rises are here to stay, not just for new rentals, but for existing rentals as well, Graeme.
And the more rate rises we have to try to tame inflation, the more rents will increase to counter the rate rises for landlords.
Exactly. Which is another, prices, wages spiral happening. And as I said, 40% of the market are renters, Graeme. So it is a strong contributor. And the reason, we haven't seen the rent increases to now in the ABS inflation data is because, of 12-month and longer leases that are yet to experience, when they get turned over, are yet to experience these unbelievable surges in rents over the past year. So not good news either for those that are on permanent leases. And again, maybe it's, motivating those to think about, well, maybe I should be owning a house and not renting a house if I can.
Absolutely.
But lots of motivation there over and above what we have for housing markets, increased demand in housing markets to purchase. So this is the vacancy rates. They did ease a little bit, went upwards a little bit over April, which we expect, Graeme, but they're still very, very low. Anything under 2.5% really does put upward pressure on rents. And once you start getting under 2%, you clearly start getting higher rents. And we're still, hovering around and below 1%, and this isn't going to go anywhere because these are historically low rates. And even that Melbourne vacancy rate for units, which is at 1.5%, is, almost, when we compare it to 6 and 7% of a year ago, it shows you how vacancy rates have collapsed in that Melbourne market, and why we're seeing, rents increasing significantly. So if you want a copy of the rent report, there's a QR code which our viewers can take a snapshot of. So we'll move on, and that will give them a full download of the April rent report. That's all right. And now we've got home prices. We've given a little bit of a preview for that a couple of weeks ago. These are April's latest house prices. As I mentioned before, April data is showing us that all capitals are now rising. And this is quarterly data, Graeme. That's a rolling quarterly model. So it's quite robust and resilient. We're taking 3 months worth of data, and we compare it to the previous month, which of course was March. It's 3 months worth of data and the trends are clear and not as volatile as monthly data. So let's have a look at the national result for house prices, Graeme. 3 months in a row now of higher house prices, so clearly the national market has bottomed out. But as we know, the national market is really about Melbourne and Sydney. Sydney, another increase, 3 months in a row for Sydney. Melbourne's its second month in a row for higher house prices. Sydney house prices now up 3.2% this year so far, Graeme. Melbourne house prices up 1.2%. Perth still going quite well. House prices up 1.2%. Over the month and up by 2.5% over the year to date. The interesting point there with house prices, Graeme, is that all capital cities recorded higher house prices over April, which I think is quite instructive. Unit prices, similarly, national unit prices up 3 quarters in a row, or 3 months in a row, usually quarterly, monthly data. And again, it is Sydney and Melbourne that make up, particularly Sydney, the bulk of that weighted average for the national price. Sydney up just 0.1%, but it is up 1% over the year. Melbourne unit market now starting to rise, up by 1.5%, flat over the year so far, but I expect that market to continue to rise. Brisbane still producing good results for unit owners, up by 0.4%, and a strong 2.6% higher this year so far, along with Adelaide. And Hobart, which is a very small unit market, Graeme, was the only market not to record an increase for unit prices over April, and it was basically steady with just down by 0.6%. So some very positive results there. We've gone through, still rising after that March and February increase, the national price. Melbourne's continuing to rise 2 quarters in a row. Sydney market's clearly bottomed out and is strengthening as the top performer. Most capitals report higher unit prices. National house and unit prices both continue to rise. And the RBA certainly, I think, did the housing market a favour with that April pause, and I think that's probably added to momentum that will continue to grow through the latter part of the autumn selling season. I had to put this one in, Graeme. We've already done this one a bit to death. But we do mention the banks and the RBA have got it wrong again on house price forecasts. The ANZ is one of those banks, and it's probably been at the forefront with some of those very severe forecasts, or those forecasts of severe house price crashes. Well, here they are. They've taken the road to Damascus, and gone back on their forecast. They said, and this is a quote from their last week's economic report, well, that's what they call it, Economic Insights, but they said there was a 9% decline last year. I'm not sure where they get that data from or what methodology using, but anyway. But the recent upturn has come as a surprise to us, Graeme. Again, because, of course, they got it wrong in 2018-19. They got it wrong through COVID. Now they got it wrong again through the higher interest rate environment. We previously thought the sharp rise in interest rates, both delivered and forecast, would continue to weigh on house prices through most of 2023, with their predictions of a 10% decline this year. Well, they now think most of the weakness is behind us. So anyway, we'll move on. But
got a lucky emoji in there, Doc. That's a cracker.
Yeah, well, we did say last year we had a couple of presentations, we had a couple of special events, Graeme, that we were railing against these 10% plus forecasts that the banks were making. We said that it wouldn't occur, that it would likely not occur. Well, guess what's happened? And I always think it's amusing that the ANZ, I'm not sure I've seen that ad recently, but they used to advertise a little app you could buy that would give you an estimate of your house price. Not sure we can look at that app with any higher sense of confidence, given how poorly the ANZ
units were down about 4.2 and houses just 4.3. So where'd they get 9 from?
I don't know. Maybe it was a month-to-month thing. Maybe it was peak to trough. Maybe it was, who knows. But the official data, and we can basically say that, and most was around about 5% at worst over 2023. It depends on how you measure these things. But they were wrong. I mean, they were talking 20, 30%, I think, in terms of declines. And, at the end of the day, the peak to trough will probably be about 6 or 7%. And we're definitely rising again now. And even they can't quibble about the outcomes. And this is the predictable, statement that we got it wrong. And they're not alone there, Graeme. Other banks are saying exactly the same thing because they also got it wrong. And you would think that banks who are the whose main business is the housing market, would be a little bit better in terms of their economic capacity to provide insights. But, I'm not sure what's going on here, whether it's the competence of their economists, whether there's another agenda running, but they consistently get it wrong. And the interesting thing, Graeme, is they get it wrong always the wrong way. They always get it wrong by saying their prices would fall too much than what they actually do, or more than they actually do. It's not as though sometimes they under-predict house price adjustments. They always over-predict the level the prices would fall, always. So,
something in that, I'm sure there's something there. I just don't know what yet.
Well, I think you've got to take whatever banks say about the housing market clearly with a grain of salt on what is significant historical evidence that over a number of cycles that they consistently get it wrong. But let's move on. And maybe that's something to do with competition as well. We only have 4 banks, of course, so basically they can say and get it wrong and they still move on and make spectacular profits. So there's the April house price report, which is available to those that want to take a picture of that QR code. So we'll finish off, Graeme. It's been a bit of a long session today. Lots to cover, perhaps as usual, but we do have those important data sets for April to look at, which are quite instructive. Really no sign of relief for tenants and certainly some relief there for homeowners with prices rising again. But, of course, we discuss this every week. The significant forward indicator is those weekend auction markets. They are a good sign of what's happening broadly in our housing markets. We know that when we look at the comparisons with house price. As I mentioned before, April is a holiday month, Graeme. Lots of distractions. Even you were offshore during April, so we move around, and I was down in Melbourne for a while. But auction markets were still strong despite those holiday distractions, where we typically see lower buyer and seller activity. Auction markets ended the month. Again, numbers were lower, with the market yet to completely re-engage following April's holidays issues. And despite the likelihood of an increase in RBA rates, last weekend results were still quite strong. And they're now consolidating. Clearance rates are now consolidating, can you believe, above the result of last year at the same time. So we have a market that's strengthened compared to where it was a year ago, which was still a reasonable market, although we were starting to head into those higher interest rate scare campaigns and environments. So that just shows the relationship between clearance rates and prices in Sydney. So that's why it makes it a good thing to follow those clearance rates, because it clearly tracks house prices. Similarly, in Melbourne, house prices follow clearance rates and vice versa. So that's why we do look at the weekend clearance rates every week, Graeme, to let us understand. Numbers were still a little low, particularly in Sydney. Again, those holiday distractions impacting the market, but another 70% plus clearance rate in Sydney, Graeme. Once again, I think fewer buyers around because of holiday issues, but another 70% result. Look at Melbourne, Graeme, 78.8%. Their auction numbers picked up a bit, but 78.8%. Graeme, do you know that is the highest weekend clearance rate that Melbourne has recorded since October 21, when it was coming out of COVID? That's the highest clearance rate since October 21 in Melbourne. Melbourne's a superstar at the moment, Graeme, but it's got plenty of, I guess, catch-up to do.
I was going to say, look, we did say that, given its substantial lockdowns, and it has to have one of the most powerful surges of pent-up demand and market recoveries that I think we'll have ever seen in the country. Has to.
Absolutely. And we're seeing that now, I think, Graeme. Melbourne still has the most affordable house rents of all the major capitals because of the COVID lockdowns driving people into particularly southeast Queensland. So there was less demand for rent. But that's all reversing now. Melbourne is the home, basically, I guess you could say, for international students. Also very strong migrant uptake. And affordability is still, positive, given that prices are below, despite our higher interest rates, prices are below where they were a year ago. I think we're going to see quite a strong Melbourne market continuing through the end of the the autumn selling season, which of course finishes around at the end of June. And this is a very, very strong result for Melbourne, Graeme, 78.8%. Like I said, strongest weekend clearance rate, highest weekend clearance rate since October the 30th, 2021, which is quite a while back. So, again, as you said, Graeme, absolutely, that there's still that pent-up demand to come through from those really severe lockdowns that Melbourne suffered. Brisbane, a reasonable result there from Brisbane from a big rise in auction numbers, 60% clearance rate. Adelaide remains the strongest market for auctions with another 80% result. And Canberra, still underperforming in regard to the other markets, but the Canberra market typically picks up as the Sydney market picks up. So we'll wait to see if that occurs again. The monthly results, you can see Sydney now above where it was a year ago quite clearly. Similarly, Melbourne now clearly above. And these are the auction clearance rates for the whole month. Melbourne above where it was a year ago. Brisbane not too far below where it was a year ago. But we've got to remember that Brisbane was coming out of a spectacular boom driven by southern migrants a year ago. And we saw unprecedented auction clearance rates in the Brisbane market, which typically tracks in the 50s, and we had them in the 80s at one stage there. So it's still pretty good results for the Brisbane market compared to a year ago. Adelaide keeps on keeping on with those 80% clearance rates. And Canberra, as we mentioned, down just a little bit down from a year ago, but picked up a little bit over April compared to March. And Canberra does tend to pick up the Sydney energy, but there are some local issues, particularly in regard to property taxes, that may be just slowing that Canberra market down a little bit, but we wait to see over coming months how Canberra performs. So if you want those auction clearance rates hot off the press Saturday night for the capital city headline auction clearance rates, get onto my LinkedIn account, Doc Andrew Wilson LinkedIn, and also the full regional report is available Sunday mornings with the Melbourne and Sydney regions and commentary. Next week, Graeme, we're looking forward to next week. Lots of data next week. Next week we may show, and this is a first, of course, for us again, we might show those regional house prices. Yeah. So we'll see how the regions are doing. We're the only ones that do that regularly. So regional house prices, this is the major regions on Australia, particularly the Eastern Seaboard region. So if you're looking for regional market data, this is the place to come, and we will reveal that data next week. Also, we have March building approvals out. Will the March results show an improvement? Well, it would go against the trend, that's for sure. Very important March retail sales. Will retail sales keep at those very high boom time levels? We also have March home loan data out, and we'll have the latest weekend auction results. So lots to look forward to next week, Graeme, as usual, and, lots to discuss.
Yeah, make sure everyone tunes in next week. There's a lot of data from this first quarter coming out that Doc and I are going to cover. And, I think you can see that what everyone expected, Doc, or was told, or almost we're almost being forced into being convinced to believe that the market was crashing, that rates were going to destroy the economy, blah, 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 blah. None of it's happened.
That's right.
It's been the exact opposite to what we were told to believe.
Yeah, and the supply-demand, relationship is still so skewed in favour of demand in rents and prices that there's no real relief in sight, regardless of interest rates. And the big picture is we have one of the strongest economies in our history, Graeme, and that's not, sort of overstating it. 3.5% unemployment rate. We've still got job creation happening. We've still got unemployment numbers falling, and we're taking just about the highest proportion ever our workforce from the population. So, this is remarkable stuff. It does mean we've got more work to get inflation down. Inflation has fallen, but it's really about the supply adjustments that would have happened, in my opinion, anyway, regardless of higher interest rates. Problem with inflation is now that, we're looking at wages chasing prices and prices chasing wages, as is happening in the US. Still a long way to go before we get back to the target. But there's no doubt that confidence has returned to our housing markets, and will continue to drive markets as long as we have this very, very low unemployment rate. Because I tell you what, Graeme, the imbalance between supply and demand is not going away anytime soon.
No, we can't build them quick enough. We don't have the materials, we don't have the labour, and we can't get them approved. But we'll look at that next week.
We'll look at that next week, see how we're going.
Absolutely. Thanks as always, Doc.
Yeah, great to talk, Graeme, and I look forward to next week.